Howdy out there, folks. It's Darius here to present another episode of our 42 Macro Bundle Live Q&A. I'm joined with the fan favorite of the program who needs no introduction, my man, Jim Carson. What's up, Jim? How you doing?
How are you, man? Good to be here.
Good, good. So for those of you who've been sleeping under a rock for the past few years, I'll allow Jim to present his bio and a little bit of background on his firm, Kai Volatility Advisors.
Yeah, I'll keep it brief. Jim Carson, managing director here and founder of Kai Volatility. We are started as a vol arb group. My background is I was one of the biggest market makers in the equity index vol space during the great financial crisis. On the back of that, built several vol strategies, long vol neutral, kind of relative value, as well as kind of everybody's favorite dealer flow, which is really measuring dealer positioning in the market and reacting for net positioning on a predictive basis for macro markets. So that's kind of the 30,000 foot view, but we really do focus on the vol space, obviously a growing part of the market and more influential every day. And I think that's our core background.
Yeah, no, you do as well as anybody out there, man. And I say clearly the volatility dynamics, particularly in and around OPEX, have become something beyond tail wagging the dog. It's more like the dog shaking its butt now, you know?
Yeah, it is the dog, right?
Yeah, and so we're certainly seeing that. And obviously OPEX, big one upcoming this Friday. I don't know if this is the most important catalyst on your screens right now, but talk to me about what you think are the most important developments to watch in your space.
Yeah, so let's start from the very beginning. March OPEX. It is always important. Go back to Feb to March 2020, not talked about enough. But March OPEX was the bottom in the market. That's not a surprise. Yeah. A lot of people were getting squeezed out, of short put positions into that massive decline. Yep. The other side of that coin is when those massive declines don't happen and people are broadly hedged, which they have been, you end up getting a Vanna charm effect, which I talk a lot about, which is a lot of delta buyback as that those skew hedges come off. And for March OPEX, it's enormous, particularly this time around because of the amount of hedging that's been going on. Dealers have been massively short put in March OPEX, massively long, cheap skew and vol behind it. They are decaying and have been decaying longer vol and longer skew and shorter delta for some time. That is the support we have seen underneath this market. Every time this market tries to, it's like beach ball underwater the last couple of weeks, despite all the negative headlines. That is why. And as you get closer and closer to OPEX, that accelerates. So all of this buying you're seeing here, people are like, oh, Zelensky, whatever news, hogwash, nonsense. It is structural flows that are natural to this market. Those things help. When you get positive news, it kind of is pushing on what would otherwise just be underlying support. But that underlying support is ultimately what is driving, that's the liquidity flows that are driving this push up here in the market. Now, that all goes away on this Friday morning, AM expiration of this Friday. That support, which we've been seeing, is removed from the market. That said, people are still well hedged. They'll still be long vol. They'll just stop decaying. Longer vol, stop decaying. Shorter delta, right? And so the actual flows will be different, but that does not mean people are not hedged. And I think that's an important distinction. As you go into OPEX, you'll have much more of a just long skew, long vol position in markets that can be supportive, but is not supportive flows per se.
Yeah, so it seems like because the gamma is obviously higher with shorter duration volatility, shorter duration options, there's so much more dominance of the Vanna charm flows in these types of windows. Whereas starting Monday, once we get to the other side of that, effectively those flows, they just die down as a relative share of the overall sort of hedging dynamics.
That's right, and this is part of this is one of the dynamics that drive seasonality in this period, right? Mm-hmm. March OPEX is big. It's kind of the first quarterly into the new year. You've had kind of that give back from late December, early January that eventually rolls over, right? And technically, markets are kind of generally oversold in that window. And then you have these massive flows that can kick off positive seasonality. Now, there are macro flows that matter in the context of this. And we are in a very unique macro environment here. If we can't get that seasonality on track. In the context of that, in the context of these flows, if we can't regain kind of technical strength, that's reason for more longer dated concern, and we do have concerns in that area.
Yeah. And absolutely. And so one thing I was sort of, we talked about this briefly prior to joining on, but I'm losing sleep at night over the context of, okay, well, on one hand, we're having this big OPEX expiry, could get a positive catalyst out of the Fed. Who knows what happens with Russia, Ukraine, could get a positive catalyst, at least a headline, if you will, at any point in time. And so if we get that sort of in this very vulnerable window as it relates to being a bear, you could actually see something that looks more like a sustained rally. But on the other hand, if we don't get that positive catalyst, and tell me what your thoughts are on this, will we see sort of investors, in the end users of these products, start to rush to get to, not necessarily rush, but start to put more hedges on as a lot of their sort of gamma is expired on Friday?
Yeah, so historically, if we look at events, this is essentially more than just March OPEX, right? Because it's a major Fed meeting as well. And those two things have layered on to create a massive inversion in the vol curve.
Yep.
The backwardation of not just vol, but skew is what's leading to these massive vol and charm flows. This is something more like an event vol, like you'd experience, during the election, which we, obviously we're very clear about how that would play out ultimately after the election. Once the event is gone, if you can get enough momentum and enough strength into it, it can really lead to a much bigger move. Mm-hmm. So you definitely don't want to be short into this window. That said, you want to be looking at the strength of the market, which we realize is here, in the context of those flows.
Yeah.
And if, in this window, you cannot regain that strength, because this is the important 3-day window. If you can't technically get to the place you kind of need to regain that structural strength and really squeeze the shorts, this market downtrend will continue. So we are flat to long in this window, looking for closely at this downtrend and measuring whether or not we're going to have a shot at taking a short here after these flows pass. That said, you cannot short this right here.
Yeah,
you cannot.
I agree. I'm feeling some pain this morning. So is there a level at all specifically that you're sort of eyeing to sort of say that the bulls have taken over and have sort of regained some strength in the market?
Yeah, so we don't like to just pinpoint just levels, right? I can, it's relative strength, a couple of different factors. You want to look at sentiment in the context of that. There was a massive turn in put call ratios this morning, and sentiment on the short-term basis has definitely turned. There's a lot of speculative buying into this. Yeah. That's a reason for concern as well. That said, there are levels above 1.5 to 2 standard deviations over the 20-day, or 20 and 21 day that we look at, which is because these monthly cycles, you really want to look at it as a function of that. And those are sitting somewhere around 4,400 to 44.5. And that area is very important if we get up there. But if you can't start to even challenge those levels in the next several days, that would be a real sign that things will end up rolling back over.
Yeah, gotcha. And then one thing I would say on kind of taking it to the chart real quick, we called this out sort of going back to a couple weeks ago, actually, where we saw, one thing we track is dispersion, looking at month over month sharp ratios as a proxy for sort of pod shop type flows, if you will. And one thing that we started to call out a few weeks ago was the sort of dominance of most shorted and heavily shorted type exposures in the upper quintile of this analysis. And what that sort of said was that, hey, look, some big firms across the buy side are taking the ball and going home. They're taking down gross. They're covering their shorts. They're selling their big sort of long positions. And that's exactly why we sort of saw that shift, back towards defensive dominance once that concluded. That would seem to suggest, in the context of what you're discussing here, that there's sort of less of a impetus, if you will, ahead of us for short covering. A lot of it's already happened, into this event. A lot of folks have made a tremendous amount of money on their short delta exposures, their long gamma exposures into the event. And so the likelihood that you need to continue to short, continue to, be hedged into the event is lower, right? So it kind of worries me if you're a bull, you have to be worried about the lack of shorts out there that can actually get trapped to perpetuate a big rally higher. Any thoughts on that?
Yeah, no, I would agree with that. I think broadly, there aren't a lot of shorts to get squeezed. If anything, there's people who need to get out still, and I think there's supply overhead. But I do agree. We're in a situation here where we've seen a lot of increasing short exposure over on certain metrics. We've seen underinvestment at certain levels, and despite that, we've seen a continued decline. Mm-hmm. That is usually a really dangerous combination. Usually when the flows, the macro flows, and the real people moving the needle are trying to get out and continue to get out in the context of underinvestment, that is probably the worst combination you can get in a market. That generally means markets are going a lot lower. Yeah. So we're watching that combination of factors kind of together, not just positioning, but positioning in the context of squeezes in windows when things should be going higher, like I was saying.
Yeah, no, we would tend to agree. I mean, we put this tweet out yesterday that said, hey, look, the Fed put somewhere between 31.71 and 34.29, if I'm being accurate on that. Obviously those numbers don't come out of nowhere. It's, based on a lot of our cycle work with valuations, things of that nature. And so if you're right at what you're saying, and this sort of dovetails into my next question, it sounds like I'm kind of gleaning your highest conviction medium-term view, and it's certainly not one of rainbows and puppy dogs, but I think we would tend to agree with that. Is that
yeah, right? Talk to me on Monday or Friday late.
Yeah.
Friday midday late, and I'll have much more conviction. Mm-hmm. But we have a definite way we're leaning right now in terms of thinking about where we'll be. It's not just up down. You got to really think about in the context of time, and time is itself not linear. So really got to think about events, post events, in the context of those events and those flows, what's likely to happen, and we really are very, very carefully eyeing Friday morning into Friday late as a moment to kind of take that positioning.
Gotcha. And leads me to my next question, which would be your highest conviction longer term view. Is your medium term view a function of a sort of bearish macro overhang, or are you sort of kind of coming up to it from a bottom up perspective in terms of the market dynamics, or both?
So when we model our distributions, we do them, they're generally weekly distributions with daily path. Mm-hmm. As you might imagine, monthly matter in the context of weekly much more than, in daily matter, weekly matter the most. So, totally. But that said, we have 20 some factors in those distributions, and many of them are annual, multi-annual. Mm-hmm. And so those matter less on a weekly basis, but we do very much have distributions that we're looking at and factors that are much more medium to long term. So I can speak to those. That doesn't mean that that's our view now, and that doesn't mean that's not going to change, because we're constantly on a week-to-week basis changing our distributions. In the midterm, to kind of speak to that a little bit. Yep. We very much, and we've been very vocal about this for years now, that we've seen an uptick in, we were seeing an uptick in inflation well before we got it. Oh, yeah. Because of the fiscal response. We believe that inflation response had secular legs regardless of what's now happening on the global stage. Mm-hmm. We are really setting up for, and this is more obvious now, but we've been talking about it for a while, major inflation. People that are kind of fading that at this point are missing the bigger picture. And the biggest factor in all of that is China at this point. If you want to step away and think about two things that matter in this world, it's the reverse of globalization and potential bifurcation of the global economy, A, and B, fiscal policy and the role of populism in the context of that. Those are the two things that everybody has to have their eye firmly on if you're looking at midterm or long-term, multi-year decisions. We believe, unfortunately, that the odds are increasingly very high that we're heading towards a bifurcation of the global economy. That's a
Yeah.
big statement. That is not just inflationary. That is not just the response of fiscal policy. That is hyperinflationary. That is not something we necessarily expected to happen this quickly. It's a trend we've talked about on a more kind of decade-long scale, but there are actions that are being taken, and there's information that we're gleaning every day that pushes us to think that China will probably invade Taiwan in the next year. And the results of that will be a break in the global economy. So until there's proof to the contrary of that, given the risks at hand, given valuations, given all of these things, that is a very hard market to macro level to buy into. Add to that the fiscal policy and probably likely increasing fiscal policy, ironically, in the face of that. There are major headwinds, obviously.
Yeah, I've said this for a while. Look, we've jumped the shark with respect to the fiscal policy response to the pandemic, right? And I think a lot of it was just really a function of the zeitgeist of inequality, the zeitgeist of at that time unemployment in the air, and ultimately, the policymakers are being forced to respond to that on both sides of the aisle, right? I mean, Donald Trump is Republican, but is as populist as anybody in U.S. politics right now. And so that in our opinion is a function of just the declining share of labor as a national as national income. All those sort of dynamics are really leading us to conclude that the solution is more fiscal, right? The problem with the solution being more fiscal, in our opinion, particularly when you have inflation, median CPI at a 6.5% annualized pace, sticky CPI, similar metric, you don't have the Fed that's there to capitalize that from a balance sheet issuance perspective. And so ultimately, we're in this awkward phase of the cycle whereby asset markets or the economy need to tell the fiscal policymakers to do more. And if they don't get more, we're going to have a slowdown back to and through and into and below trend from a GDP perspective. That's our forecast and has been our forecast. I mean, we continue to laugh, and at this point, we're laughing. If you go to chart up column, that the Bloomberg consensus estimates. This chart, I just checked it this morning before to update the deck, and it's the same as it was a week ago, which is we're still calling for 3.6% growth in 2022, which is 160 basis points north of our potential. Where in the hell are we getting that 160 basis points? Why is it not 160 basis points below potential? And so to me, I think we do need to have this growth slow down so that markets can reprice in a more bearish manner to tell the Fed they need to actually start to buy more bonds because the fiscal authority is going to issue them. That, to me, that process is still ahead of us from a financial market perspective, which is why we are personally so bearish.
Yeah. So I agree with that. I think, I don't know that GDP growth, at least nominally, is going to slow down that much. I think the fiscal response will. Yeah. And particularly, even in real terms, I do think that margins are going to start, that's the thing that people aren't talking about enough. I think margin contraction is going to be significant in the next couple of years. I think we're going to start hearing a lot more about that in the next earnings cycle. I think a lot of the projections for earnings growth have the wrong margin assumptions embedded within them. I think we're going to see price to sales, which has been at record levels, improve. But I think price to earnings is going to adjust accordingly. I think that's a big macro kind of thing to keep aware of. That's generally what happens during these inflationary periods. Interestingly, I think, markets are priced nominally. I think the more inflation we get, ironically, nominal volatility might decline. Yeah. I think that's something that people aren't really thinking much about either.
Yeah, interesting. Turn up for some questions from the audience, man. Appreciate you. So we got a first question from Mitch. Says, how can one use the Vanna ratio in an option strategy? Are there lower monthly ratios, a better setup, or have a better hit rate?
Yeah, I mean, we look at Vanna not necessarily at kind of these public ratios or whatever. We have different measures. But obviously using Vanna in the context of these strategies is really understanding, having the right metrics and really thinking about, when they are going to be, how big relative to the liquidity in the market. I think understanding the actual liquidity in the market that can absorb these flows, what percentage of that liquidity and the net liquidity, I think, is important. I've talked about this quite a bit, but I think very few people appreciate how little liquidity there is in the market on a day-to-day basis, how little it takes for markets to move, particularly in different windows. That liquidity is not always the same. And so understanding how little that is, again, it's often 50 to $75 billion in a day, in a $50 trillion market, is about how much it takes. And as we know, those Vanna dollar amounts, that liquidity can often be, more than 50% of that in certain windows, and often even more. So sometimes it's 10%, right? But during certain windows like this, it's significant.
That's kind of, I imagine that's creeped up over the years. That seems really high.
Dramatically so, absolutely. And it continues to. But again, it depends on the periods, right? During periods of less liquidity, like end of the year, there's less time, less liquidity. We've talked about this in our newsletters about how time and volume weighted time changes these dynamics quite a bit. But understanding that's half the equation that people don't think about is really how much liquidity does it take? How much, how much bidding versus supply, how much net demand does it take relative to liquidity, and using that in the context of these flows is really important.
Makes sense, man. Thank you. Oh, sorry. Getting the question scroll on me here. Oh, sorry. Zilvinus is asking if this sort of window of time, this sort of where bulls need to take charge, kind of turns into a sustainable rally, and we get over let's call it 4450, 4500. Will we see new all-time highs in the S&P possible? Either, I'm not sure if they're asking from a technical perspective or from a macro perspective.
Yeah, so there's multiple factors. Like I said, I don't just look at the level, right, and say, oh, if we get above 44.5, we're going up. It's more complicated than that, obviously. I think these macro flows are very much tied to what will be going on in China and clarity there. So on a macro basis, I would need to see, to get bullish. To get neutral is one thing, right? But to really get bullish, we'd have to really see some resolution from China, at least some lip service to walking back towards, a global kind of working together.
Yeah.
The threat of a bifurcation of the global economy is a big deal. Now, technically speaking, yes, the more we can force these, these strategies that have, trend following and, vol targeting and, risk parity, the more that we can move these things, the momentum that is purely negative at this point the other way, you can get some break in momentum that can start pushing things up. And sometimes, just some resolution from this macro side, paired with that would be probably what you need to see to get a real squeeze there. So that's, we're looking at both those longer term factors as well as these technical factors. We'd also want to see it in the right kind of windows. And again, so that would be, it would have to start soon.
Yeah.
Once we get into May, also, if you start to fade again, there's bigger seasonal and structural factors that you also would be looking at as well.
I was on a call with a very well-known credit fund, their risk management team, and the conclusion of the call, both from both parties, two separate processes, was sell in May and go away.
Yeah.
If we do see a rally on this, we were sort of scenario and analyzing the probability we got a rally through the Fed. And, taking it to the chart again, one thing we talk about as it relates to our grid model framework is the speed of, well, one, obviously the regime matters, what regime you're in matters, but the sort of speed of the change in growth and inflation have a really outsized influence on sort of the, kind of the aggression, if you will, and the dispersion that we see in asset market response. And so you're going to start to see, at least according to our models in the month of June, that magnitude of change in terms of the trending deceleration we've been on cyclically. By the way, we've been in a trending deceleration since Q2, well, not just in the U.S. economy, since Europe started peaked in Q3, China's Q1. The whole world has been slowing for a while now. That pace of deceleration will start, at least according to our models, will pick up in June. And so when will the market start to look forward and say, hey, look, the one thing I haven't had to price in legitimately yet is a growth slowdown. For all intents and purposes, growth's still fine. It's just that we got the Fed, we got Russia, Ukraine, inflation's really high, all this other stuff. But the one thing that markets haven't had to do is price in that growth slowdown. And to me, I think that's super important, because when you start talking about a modest deceleration, if you will, in what we're calling an inflation regime, you're talking about a -2 to 3% annualized. But when you get into a -2 sigma deceleration, which is where we're going to start to see in the back half of the year, you're talking markets going down 13 to 22% annualized per month. And so that to me is a real big issue that's ahead of us from a market risk perspective, which is why I do believe that if we do see any sort of sustain bounce, into and through this sort of window of potential window of strength, it's very unlikely to be sustained, well into the summertime.
Yeah, I agree with that. I think to add to that, kind of an amplifier to that is the fact that we're reopening from COVID, right?
Yeah.
And I think people, have known this for a while, but we've stopped talking about it. Like, you're going to get a big, and you are getting a big push here. That's not particularly a natural push in the spring. That will likely have some give back post spring. And so I think that only emphasizes what you're seeing there.
Good point. Absolutely. Larry's asking how you sort of mentioned this. Just I'll summarize real quick. Larry, how you doing? Says how are you positioned going in the FOMC meeting? You were sort of flat to neutral, flat to bullish. You're saying?
Yeah, flat to bullish. We have been, broadly, short some calls overhead, long some stock, more shorter dated, and some, have broadly. And again, this is broader positioning, but have had calendar put spreads on because skew has been very, very low.
Gotcha.
That's a very specific, but it's obviously cross asset, different, a bit more complicated, but that's the general positioning. Skew has been incredibly low. We went from massively over demanded, very high, to very oversupply, and that was part of what was also supporting markets and gave us the confidence that this thing, couldn't roll over in this window in the context of those Vanna charm kind of flows. So very bullish window because of that, because of the things we've said, but also bullish for skew into a rally. Which I think is important.
Gotcha. And that would sort of temper the rally, if you will.
Yeah. So once skew comes back up, right, then you're in a situation where you could start to see more fireworks potentially on the back half when things do roll back over.
Sounds good. Thank you. Oliver's asking, hey, Oliver, how do you think bonds will behave in this sort of complex macro environment?
So the Fed is under immense political pressure here. So is government, honestly. The word inflation you're going to hear it more than it was populism. It was kind of inequality, probably was the word for the last 2 years. The word now is now inflation. And we're about to head into a time political period, right? With the midterms, Republicans will use inflation as the political bludgeon, and that's going to lead to certain type of outcomes. One, the Fed is going to have to, for their own quote unquote credibility, try and be aggressive, and they're probably going to be relatively more aggressive early rather than late because they don't want to be entering the fray too much. As you get closer to midterms. And so, in that context, I think you're going to, probably see, my biggest bet on bonds at this point, because it is kind of, you're going to see generally low volatility, like support in the short term for yields, and then kind of a fading of that. But I think we're kind of stuck here in this, around 2%. For a while in the 10-year, and then increasing secularly, after kind of midterms.
Gotcha.
Would be my guess. But again, I think there's other points. This kind of dovetails. I'll just take some liberty here and jump into. I think that I think the best investments right now are going to be focused on, where is the government investing. I think you're going to continue to see the major flows of liquidity not coming from the Fed here going forward, but really coming from government. And I think that will mean energy responses, right? You'll see more fiscal, but it won't be called fiscal. It'll be called, and it won't be called price, controls, but they will essentially be price controls. I think you're going to see support of first-time home buyer credits. You've already heard about energy kind of tax kind of credits to help offset inflation. But I think the worse and worse inflation gets here going forward in the next 9 months to year and a half, you're going to see more and more responses that aren't just supply side, but are things that are geared to help the populace, um, deal with the cost of things, and that's ultimately long term, even more inflationary, right? That's still more fiscal policy, and I think that's an important thing to be aware of.
That's my so in terms of the path dependency on all that, because I definitely agree that the baton has been squarely handed to the fiscal authorities, right? And the issue with, again, as I mentioned, with financial markets is that the rest of the world doesn't want our bet. And I would argue after the last few weeks of shenanigans with respect to Russia's central bank reserves, they're going to increasingly not want our debt at a faster pace. And so someone's got to buy all that incremental fiscal response, right? And my I guess my point on asset markets is, if markets or the economy have to tell the fiscal authorities when to turn it back on and dial up the sort of spending meter, if you will. And so this is my sort of one of my core theses is I'm sort of pushing it to you to see if you get your pushback on it, which is we're going to have to get to a place this year where the markets tell the Fed to get back engaged and tell the fiscal authority to get back engaged. And we're probably going to have problems in asset markets until that occurs, until we get to a place that says, hey, no, do more, not less.
Yeah, I think that's true. And I think we will see that in the short term. I think this will be the new hammer and dance. Fed will come in and out of the, of this. Look, this is, the Fed wants to be dampening of volatility. The Fed wants to control this increase in interest rates and multiple contraction that we're ultimately going to see. I don't think they can prevent it at this point. If we are going to normalize interest rates, this is the way things work. So go take 68 to 82 as a kind of loose model. Interest rates started slowly; they were secularly increasing. The Fed tried to control it, tried to play kind of in and out and manage it. Ultimately, it got to blow off top.
Totally.
And a lot of the effects of government on trying to control that inflation ultimately just reinforce the secular trend. And I think that's what we'll see. I think government and the Fed, everybody is incentivized to try and control volatility, not to make it a worst case scenario. So if you think of macro outcomes and you look forward a decade or so, the least painful way forward, is really nominal markets going nominally nowhere for 10, 15 years, right? Up and down and ultimately, losing 75% or 70% of their value in real terms, and cash losing the same. It's more politically palatable. It's slower. It's just a tax ultimately. And that's the most likely outcome. And policymakers, both on the monetary and fiscal side, will likely do policies that in the short term remedy these issues, and in the long term cause it, make it worse. That's just what they do.
Exactly. All right, man. Well, you've been very generous of your time, man. I appreciate you. Do you mind if we do 3 quick rapid fires before we wrap up?
Absolutely. Let's do it.
Yeah, cool. So start with Zilvinus asking a question. If China invades Taiwan, does that mean that obviously means a financial market crash? Do you think we could head into a deflationary recession before we get into that high inflation outcome?
I think it's stagflationary.
Yeah,
I don't think it's deflation or inflation. It's inflation in the context of a weak economy. That's what we've been saying for a while. We just don't have the bandwidth to, margins will collapse. Supply chains will disappear. Inflation will be everywhere. But that's not good for markets either. So it's stagflationary.
100%. And then Anthony's asking, with an assumed GOP takeover in November with the midterm elections, do you think there's a potential shift to more permanent more permanently expansionary fiscal policy could be delayed?
I don't think that. I think the base of the Republican Party is just as populist as the base of the Democratic Party at this point. Yep. At least in the context of Trump being involved in that base that they're appealing to, being involved. And so, no, I see continued fiscal. I do see a more balanced approach, I guess, in the sense that there will be more supply side responses, particularly to carbon, to energy. I think you will have a major supply side response, Bakken, Permian, the credits on the supply side. But I do think fiscal will continue. There'll also be price controls. They won't call them that, obviously, but things to help kind of popular things for people to help demand in the context of that.
Sounds good. And then my last question, my personal favorite, what's one risk management sort of idiom or lesson that you live by today that you wish you knew, at the beginning of your career?
I would focus on liquidity.
Yeah.
I think liquidity broadly, and I know that means a lot of things. What do I mean by that? Liquidity is undervalued. The risk premium for liquidity, you look at calendar spreads in vol or yield curve, right? You look at, not just duration, but number of open positions and ability to get in and out. I think the reality is that liquidity is harder and harder to come by. And during times of particular stress, that diminishes dramatically. Look at, particularly as it relates to duration and time. And again, it's not just on the yield side. There's a reason the word long-term is in long-term capital management. The reality is long-term positioning is not tied to any type of real fundamental value. Supply and demand can make things go anywhere they want.
Totally.
And at the end of the day, if you are not managing your liquidity and your duration, the risk is infinite. And so I think the biggest lesson is always be in a position of liquidity strength, of owning, even though there's risk premium to it, and theoretically, these things may look like they're like irrational pricing. Risk premium is very high for those things. Ultimately, you still want to own that liquidity tail, and I think that would be the thing I would most focus on in terms of a lesson.
Well, Jim, I appreciate that, man. Very thoughtful as always. We appreciate you joining the program. Jim Carson, founder, CIO, managing partner at Kai Volatility Advisors. You are doing yourself a great disservice if you're an accredited investor. You guys haven't checked them out yet, so definitely go do that to the extent you can. Appreciate you. Catch you back here next time, my friend. Thank you.
Absolutely. Thanks, Darius. If anybody wants to reach out, we're actually going to do, we're offering up our newsletters to macro bundle suppliers, macro bundle subscribers who want to come to our website and kind of just fill out a form and request them. We're happy to share our last 5 newsletters with your
you're the man, customers. Man. Appreciate you, bro. Thank you so much.
Absolutely. Thank you for having me.
Cheers, man.
Good chat. Take care, buddy. Bye-bye.